Soumya, you go first. Shocker, 4.88?
Yes, I think the numbers is actually significantly on the higher side, and we had actually factored in an 18% increase in vegetables, but as per your observation, it's grown at 22%.
Yes.
So that means that itself has added another 20 to 25 basis point from what we are estimating. So that takes it to 4.70. And if I look into the core inflation number, that has also been a little on the higher side, which is at 4.86. So that's a jump of around 30 basis points. So it's not only food driven, but there are also elements of core inflation which has driven up this inflation number on the higher side. So it's an overall trend which looks a little bit discouraging at this point of time.
Soumya, how does this compare with the RBI's fan chart? Were they anticipating as bad as 4.9 almost?
No, I think for the first time the RBI estimates of 4.3 to 4.7% are likely to be exceeded because we were expecting around 4.8 to 4.9% based on today's number, and since today's number has gone up by around 30 to 40 basis points higher. So there is definitely going to be one or two prints which will put the inflation number higher than 5%. So from that point of view, I think the RBI estimates of 4.3 to 4.7% is likely to be exceeded for the
for the current year. I will, Soumya, I will come back to you to check out the core inflation as well. But let me get first thoughts from Tushar and Indranil Pan as well. Indranil, this number shocks you. 4.88% is the November inflation compared to 3.58 in the previous month. So 130 basis point jump.
Yeah, we were looking at a much smaller number. We were more in the range of 425 to 430, simply because we had not factored in such an increase in the vegetables. Because the vegetables data, if I really look at from various sources, gives up various types of numbers in terms of the MOM increases. But having said that, if as Soumya points out that the core inflation also is on the higher side, it possibly indicates that there is a more sustainable inflation pull to the economy at this point in time, which to a certain extent gels with what the RBI's thought process on the inflation and the fan chart that you just mentioned sort of pans out.
Well, let me get to Tushar's thoughts as well and then ask you all, where is this whole trajectory headed? If we are already at 4.88, where are we ending this year at? But first thoughts from you, Tushar. I hope you got all the important numbers. Food inflation has come in at 4.42. Overall headline index coming in at 4.88. Big culprits in food inflation is vegetables, 22.5. And eggs, of course, which we all know, 7.95. So that's almost 8%. And miscellaneous, all told, is 3.63%. Soumya informs me that the core inflation is 4.86. Your thoughts, Tushar?
So we had factored in a number of 4.5%. So yes, it is a bit higher than what we had expected. But I think in terms of what has not come in line with our expectation is the core category and things apart from food, because vegetable prices and also egg and other protein related item, mutton, I think we were actually expecting a good substantial upside risk on that front. This also means that the GST tax rate cuts which were announced for some of the important items which really belong in the core category, that has not really transpired, and I think maybe it will come back in December because this happened in between the months. So maybe in December we can expect core to again marginally soften, but I think the upside in core really poses some worry. And if that's the kind of trend, earlier we were expecting March number to be around 4.6, 4.7. Now this month-on-month higher momentum in November, this means March we could land up somewhere close to 5% now. So I think that's a bit of a worry, and that means RBI should stand pat. And I think if the trend remains something like this, then maybe markets start thinking on the negative side, maybe in the second half of next year.
Yes, perhaps the market's satisfaction that for all of calendar 2018, we will not get any rate hike could get disturbed a bit. That is my big fear. Soumyakanti Ghosh, after looking at the inflation numbers today, how would you draw your trajectory up at least until March?
See, Lata, before I talk about the trajectory, I'll just talk about one very interesting observation. I think Indranil pointed out a little bit, but the point is that why you are getting so divergent inflation estimates, and apart which is coming out from the market, is the complete, misunderstanding the food inflation scenario. And the interesting part is that at the mandis, the prices are rising at a much lower rate. I think around 3% was the average, weighted average for the entire month. While at the retail level, the prices are jumping by 9 to 10%. So that actually is putting up a spanner in terms of the estimate. So that is a significant wide divergence at the wholesale and retail level. Now, having said that, in terms of the inflation trajectory, I think our whole year inflation average was around 3.6%, or now that should have a definite upward bias. Next 2 to 3 months print could be printing over 5%. There should be at least some numbers. At least, in fact, next month number could be in excess of 5%. We could get 2 months of 5% number, and the inflation average for the second half of the fiscal, which was at 4.3 to 4.7% by the RBI, could be closer to 5% now, if not more than that, if the trends continue to remain like this. But if we see a faster deceleration in the vegetable prices, I think vegetable prices have started to cool off a little bit as of now, then there could be some downside to the estimate. But as of now, we should be broadly in line with what the RBI expects in the second half of this fiscal year, which is 4.3 to 4.7% average.
But why are you saying we are broadly in line? I thought we are higher than what the RBI is. Aren't we, Indranil?
I think as Shoma pointed out, it's becoming quite difficult in terms of estimating the trajectory of the inflation. First of all, as Tushar pointed out, there could be a positive implication from the GST perspective and the rate reduction coming into December. Onion prices and some bits of vegetable prices have started to cool off. So we really need to sort of factor in how much of cooling happens on the vegetable prices, because the biggest shocker in this particular inflation reading was the vegetable prices. So broadly, we were before this data came out, we were looking at the end March number at around 4.5%. We might have to revise it higher, but very honestly, I think we will have to do at least 3 or 4 more revisions as each month's data comes out, because I think the variability in terms of the different items within CPI is quite high.
Okay, so no, but still more or less you are looking the year ending at what would be your second half average and your March number?
The core in this particular data is actually above the 5%. If I'm not mistaken, it's about 5.25, which necessarily means that if the core pressure continues, we might have to look at around a close to around 4.8, 4.9% is where the headline CPI could be ending this year.
Okay. Tushar, will you be changing your year-end trajectory? At the moment, what's your March end number and your second half average?
So at the moment, my March end number was around 4.6, 4.7%. Now, after this number, as I mentioned earlier, I think it could be close to 5% now.
All right.
One important thing to understand is that, items like tomatoes and onions, which really led to an upside risk, inflation pressures this month, they might cool off because they generally follow a 3-month cycle, and that might come down. But there could be other vegetable prices or food in general, which could pose some upside risk. Because remember one thing, Rabi sowing has not been that great this year, and there might be implications from that front. So food trajectory might be a bit uncertain and might be volatile, I think, even in months to come.
Okay. In that case, and this is the more crucial question, we'll also have a bond expert joining us in a minute. But Indranil, you all guys are also market experts. Indranil, how would the 10-year move now? Basically, will the market start factoring in an RBI hike sometime in 2018?
But to a certain extent, my belief was that the last 2 days of movement was because the market was sort of to a certain extent nervous of the inflation reading that might come out. The whole of December, I think it could be a bit of a struggle unless and until we see the demand for grants, the demand for fresh budgetary allocations that the government might be asking for, and what are the ramifications it has in terms of the sense of the market, in terms of the overall borrowing program. So at this point in time, given the fact that there absolutely looks no chance of a rate cut by the Reserve Bank of India, we would possibly be moving as within the current range of, say, about a 720, 725. Immediately, I don't really believe that it can go significantly higher at this point in time. But if we have a feeling that there might not be a significant additional borrowing by the government, we might see some amount of cool off in the yields somewhere around January. So broadly, I think I'll probably still stick to a 7-7-15 sort of a range by end March 2018. Of course, hoping that there is no significant additional borrowing by the Reserve Bank of by the Government of India.
No, any rate hike in calendar 18?
At least for the first 6 months, I think as RBI says, they would be extremely data driven. We'll have to watch out for the next couple of prints, or at least the next print before the RBI meets again in February. We have a very significant announcement coming up on the 1st of February. So I think it's absolutely a data driven phenomena that we should be looking at from this point in time. But at least we are confident in saying that there is no rate cut from the Reserve Bank.
Oh, I think that, of course, goes out of the window, and I think the Reserve Bank's language didn't leave us in any doubt at all. In fact, it didn't leave us in doubt, I think, for the last two policies. Soumya, what is your sense? Should we start penciling in a rate hike from the Reserve Bank, or is all this, to some extent also a low base? We all know that we have entered demonetization month a year ago, starting November. So should we just look through and expect the RBI to look through these 5+ numbers? Or do you think that a rate hike in 2018 now becomes a possibility?
So no, I will not go to the extent of any rate hikes, at least in 2018, because the markets also and the central bank also needs to take into account the IIP numbers, and as we know, the yield, even though the yields have touched 7.2%, I think there is also evidence that the yields are to a large extent determined by the real economy factors. For example, IIP growth is one of them. So the market will also take into account the weak IIP growth and the fact that the IIP actually has been started to decline from the last 2 months, from a 4% level to 2.2% in the current level. Now, having said that, I think next year, even though we'll see our inflation printing at, say, maybe our March number was around 4.8%. So even if it say prints to 4.9 or 5% in March, we still believe that the second half of next fiscal, if everything goes the way as it is going right now, could see some good inflation prints. And August, September, because we'll take advantage of a favorable base in the second half. So my sense is that January to June of the calendar year next year could be a little bit unfavorable in terms of the inflation trajectory. Some prints in excess of 5% possibly, but as July to December is the time when the inflation prints could actually be a little bit favorable to the government, to the RBI.
So no rate hike.
So in that sense, I expect that the next year inflation average. So therefore, I think the RBI should stay put for this purpose, and given the fact that real rate of interest at significantly high levels, there is enough cushion for the RBI to weather this crisis and weather this data and stay put for a significant maybe for the rest of FY19 or so.
Okay. Tushar, very quickly, do you expect 2018 hikes at all? Will the market start factoring in one when it opens for trading tomorrow?
I think on this front, I will concur with what Soumya said. I think it would be too early to call for rate hikes because in the second half of next year, inflation would start, softening to around 4.5% level. So rate hike, our baseline scenario is there will be no rate hike, but certainly market would start, playing on this, and there would be some sort of fear which would impact yield on this front. But I think having said that, there could be some value buying maybe by end of December because there could be some positive surprises on the fisc front, at least. I think with government, putting out their roadmap and saying that, they would be actually meeting the consolidation path.
Okay.
I think there could be some value buying from that angle.
Oh, right. We've got a bond expert as well joining us. Do stay on, gentlemen. Ashutosh Khajuria, Executive Director at Federal Bank, has joined us on the phone line. Mr. Khajuria, 4.88, only one person, Rupa Regenitsure of L&T Finance gave me that number, 4.88 to the dot. All other numbers were much lower than this, and I had several readings of people giving me even 4.2 and 4.24. So looks like the market's definitely going to be jolted by this number. Where do the yields go tomorrow? Where do you see the yields till March end?
I understand this was factored because since morning when we saw 7.23, that range, above 7.20%.
Okay.
I think it was factored that the number is not going to be closer to 4.25 or 4.30. It's going to be above 470 or so, because that was the grapevine. So everybody was talking about 470, 480 and all that, I mean, that's today's story.
Yeah, but market still ended at 7.17, didn't it?
Yeah, that's what I was just coming to that. I think if you just compare it with the repo rate, the spread now would be about 120 basis points.
Yes.
And just a week back, you had RBI reiterating that they are going to follow the neutral stance. In neutral stance, if you just go back to last 15 years, you will see that repo rate to 10-year spread would be between 60 to 80 basis points in a neutral stance.
Okay.
In a bearish stance, it goes above 100, and in a bullish one, it can go to negative also.
Right.
So I think this suggested a good buying signal, and I saw people, aggressively buying above 723, 722, 723 levels. Within minutes, it came down to 718, 719. I expect 10-year to come very soon below 715 or so because of the adverse base effect and some sort of weather-related vagaries. The food inflation had gone up in November, fruits, vegetables and all,
Sure.
whether it was, onions or tomatoes and all that. And it has ultimately resulted in a more than expected number.
Okay.
But the same number is going to become base for next year, and I agree with Soumya. I don't expect any, repo rate being done in hurry. Of course, it would be data-driven and all that. But the same numbers right from July to December would become base for next year, and that would be very conducive to really going for maintaining a neutral stance rather than going for any hike.
Okay, your optimism on interest rates and inflation is welcome, all of you gentlemen. But I just worry that, we had an expert telling us earlier today that he wouldn't be surprised, and he is a person who follows commodities closely from Fat Profits. David Lennox telling us that he expected crude to be between 70 and 80 for a better part of 2018. So growth numbers have also been revised higher in Europe. The last 2 quarters in US have come in at 3% plus. So there are growth impulses pushing up prices globally, even if inflation is still under control in most of the Western countries. We have to keep this global backdrop and the fact that there is a rate hike from the Fed and probably some indication of what kind of rates we are going to get. Rate hikes, how many rate hikes we will get next year as well. So the global backdrop is on the hawkish side, I would say. And in that context, this 4.88 is going to play on people's nerves, especially those who hold NBFC stocks. Deven Choksi has joined us, the director at KR Choksi. Deven, we've got an inflation number at 4.88. Our poll had thrown up 4.45, and there were guesses in the market at even 4.3. So significantly higher than what the market expected. Yields could be around the 7.15 to 7.2% for some time now. Do you see an adverse reaction in the stock markets tomorrow?
There will be knee-jerk reaction, Lata, for sure, I think, for this number. And people have been expecting inflation to cool down, which is not happening for a variety of reasons, which we all know. But the fact remains that I think country is progressing well. And even though the yields shoot up to 7.1 to whatever, I think the flow in the market is not going to get disturbed. That is one thing which is very obvious and clear to me. So growth, people will bring money for growth. I think irrespective of the level of inflation that we are seeing. Because this inflation is not a crazy inflation.
Here the inflation, most of the asset prices are under control.
Fair enough.
Maybe at the retail level, I think some amount of disturbance,
Fair
which
point.
I guess I think the supply side situation clearing will resolve. Yeah.
Take your point. I mean, this is not a crazy inflation, not that 3-4 years of double digit that we saw. But nevertheless, I think the worries will really be if crude continue to persist higher. Thank you very much, Deven Choksi, for joining us. I quickly want some IIP reactions. I've relegated that to the background. 2.2%. Soumya, very quickly, will that make you worry about your growth numbers?
No, I think the October was a muted month, so I was not expecting too much of an upside on the IIP numbers. But I think what worries me is that electricity has actually slowed down in October, and the scenario is unlikely to change in the next couple of months. So if I take that into account, and given also the reports that coal production may not materially pick up, I don't see too much of an IIP traction in the next couple of months or so.
Fair point. Indranil, 2.2, is that a big disappointment?
Well, I think for the year as a whole, we had penned down a 6.2% GDP number after the Q2 numbers came out. So in line with more or less how we had been expecting, I don't think there is a significant investment push from the private sector that is coming up, which necessarily means that we will continue to see sort of relatively muted numbers on the IIP, and that to be sort of reflecting in the GDP. Now, the concern comes from the fact that if the input side of the picture is actually picking up in a significant way, whether the manufacturing sector growth that had held up quite strongly in Q2 continues in the next 2 quarters, because that's based on the earnings numbers of the corporates, and there could be some sort of a fear out there.
Okay. Very quickly, Tushar, in 10 seconds, IIP number 2.2.
We were at around 2.8, so it is a bit lower than what we expected. But we anyway expected, a bit of slowdown happening there. Mining was the base effect was not so favorable, and electricity we anyway had a clue from the infra numbers. And this is how we expect the trend to pan out for the remaining part of the year. We expect a U-shaped recovery. I mean, it's not a very rapid recovery process which is going on there. So
fair enough. I just wanted to add that the the September IIP number has been revised up slightly from 3.8 to 3.9. So the overall inflation, the IIP number from April to October remains at 2.5%, which is anyway not terribly impressive. So all of you gentlemen, Ashutosh, Tushar, Deven, Soumya and Indranil, thank you very much for joining us in this special coverage of the macroeconomic data. The news from the macroeconomy is that inflation is higher than we thought, growth is lower than we thought. That's a bad combo.